Most investors believe that once a stock has already made its big move, the opportunity is gone forever. They think if they didn't buy early, there's no point in paying attention anymore. That belief is comfortable, but it's also dangerous, because markets don't move in straight lines and breakthroughs don't happen just once. History shows something very different. When one company proves a model works, it doesn't end the story, it starts a wave. And right now, many investors are asking the same question. If they missed Palantir, what comes next? Artificial intelligence has shifted from a buzzword into a foundational technology. It's no longer just about futuristic promises or experimental tools. AI is being embedded into government systems, defense infrastructure, healthcare, finance, and enterprise operations. But behind the excitement lies a deeper issue that rarely gets discussed. AI doesn't scale on ideas alone. It scales on real-world systems, data, energy, infrastructure. And the companies that quietly solve these problems often grow long before the spotlight finds them. This hidden problem matters now more than ever, because AI adoption is accelerating faster than the systems that support it. Governments are deploying AI for national security and public services. Corporations are integrating it into everyday decision-making. Data centers are expanding globally. All of this requires more than software. It requires reliable data integration, massive computing power, and energy systems that can operate without interruption. When these foundations fall short, growth slows. That gap is where new opportunities emerge. Most people focus only on the visible layer of AI, the interfaces, the models, the flashy demos. But the real value is often created behind the scenes, in the platforms that organize data, in the infrastructure that powers computation, in the systems that allow AI to function at scale without failure. Traditional approaches struggle here. Legacy software systems are fragmented, energy grids are stretched, infrastructure projects move slowly. The next phase of AI growth demands solutions built specifically for scale, security, and reliability. That's why a new category of companies is gaining attention. These are not consumer-facing tech giants. They are enterprise-focused, infrastructure-driven businesses operating in complex, regulated environments. They don't promise overnight results. Instead, they focus on long-term contracts, mission-critical use cases, and deep integration into customer operations. This category exists because traditional solutions were never designed for the demands AI is placing on the real world. Once the shift becomes clear, the conversation naturally turns to specific companies positioned to benefit. The first company investors often compare in this space is Palantir, which proved that complex data platforms could become deeply embedded in government and enterprise workflows. But Palantir's success also revealed something else. It showed that when a company solves a hard foundational problem, it creates a blueprint others can follow in adjacent areas. That brings us to the next potential candidates investors are watching. The first stock many analysts point to operates in the space of AI-driven energy and infrastructure management. This company focuses on helping utilities, data centers, and industrial operators manage power demand more efficiently using advanced analytics. Its technology doesn't try to replace existing systems. Instead, it layers intelligence on top of them, optimizing performance in real time. In a world where energy demand from AI is exploding, this kind of software becomes increasingly valuable. What makes this company important is timing. As governments push for grid modernization and companies seek ways to reduce costs without sacrificing reliability, tools that improve efficiency gain priority. The technology is relatively simple to understand. It collects data from multiple sources, analyzes patterns, and helps operators make better decisions automatically. The result is lower waste, improved uptime, and more predictable operations. It's not flashy, but it solves a real problem. Financially, this company is still in a growth phase. Revenue is increasing, but profitability remains a work in progress. That's common for infrastructure-focused tech firms. The key is customer retention and contract length. Long-term agreements create predictable cash flows over time. The risk is execution. If deployments slow or customers delay spending, growth can stall. This stock is not without uncertainty, but it sits directly in the path of AI-driven infrastructure demand. The second stock gaining attention operates in the semiconductor supply chain, but not where most investors look. Instead of designing cutting-edge chips, this company specializes in the equipment and processes needed to manufacture them. As AI models grow larger, demand for advanced chips increases. That demand flows upstream to the companies that make chip production possible. This is an indirect but powerful way to benefit from AI growth. The technology here focuses on precision and reliability. These systems ensure that chips are produced consistently at scale, with fewer defects and higher yields. In simple terms, they help factories make more usable chips without constantly retooling their processes. As new fabs are built around the world, this type of equipment becomes essential. Governments supporting domestic chip production further strengthen this trend. From a financial perspective, this company tends to experience cycles tied to capital spending. Revenue can fluctuate depending on how aggressively manufacturers invest in new capacity. That volatility introduces risk. However, long-term demand for advanced semiconductors remains strong. Investors watching this stock are not betting on a single product cycle. They are betting on sustained global investment in AI hardware infrastructure. The third stock often mentioned alongside these discussions focuses on secure data integration for regulated industries. This company helps organizations connect, clean, and analyze data across fragmented systems without compromising security. As AI is adopted in sensitive environments like healthcare, finance, and government, data integrity becomes critical. You cannot train reliable models on incomplete or unreliable data. The technology emphasizes control and transparency. Users can see where data comes from, how it's processed, and how decisions are made. That matters in regulated industries where accountability is required. Instead of acting as a black box, the system provides clear oversight. This approach aligns well with growing regulatory scrutiny around AI usage. Financially, this company is still early in its growth journey. Revenue is expanding, but margins are under pressure as it invests heavily in development and customer acquisition. The upside comes from scalability. Once embedded, these platforms are difficult to replace. The risks lies in competition and adoption speed. Larger players could enter the space, and customers may take longer to commit than expected. So, why is all of this happening now? The answer lies in convergence. AI adoption is accelerating. Governments are investing in technology infrastructure. Energy demand is rising. Regulatory frameworks are evolving. These forces are pushing organizations to rethink how they operate at a foundational level. Companies that offer solutions aligned with these needs are seeing increased interest from both customers and investors. Market momentum also plays a role. When one company like Palantir demonstrates long-term value creation, investors begin searching for similar patterns elsewhere. They look for businesses with strong contracts, mission-critical use cases, and long runways for growth. That doesn't guarantee success, but it narrows the field. None of these stocks are guaranteed winners. Each carries real risks. Execution challenges, competition, policy changes, and economic conditions can all impact outcomes. These are not short-term trades. They are long-term bets on how technology integrates into the real world. The upside potential exists because the problems they address are not going away. The downside risk exists because solving big problems takes time. The key takeaway is this: missing one opportunity does not mean missing them all. Market leadership rotates. Technologies evolve. New winners emerge as foundations are rebuilt. Investors who focus only on headlines often arrive late. Those who focus on infrastructure, timing, and long-term demand sometimes arrive early. If you missed Palantir, the story may not be over. It may simply be entering its next chapter. The companies working quietly behind the scenes today could become the essential platforms of tomorrow. But patience and discipline are required. This is about understanding risk, not chasing hype. If you found this analysis helpful, take a moment to like this video and share it with someone who follows AI and technology stocks. Subscribe to the channel for more long-form market stories that look beyond the obvious. Thanks for watching, and I'll see you in the next one.